on that area, so that those that in that lesson I'll read through. We had already started, but I'll just start from scratch in this particular question. Yeah, we had analyzed the assumptions. I'll just go through them. And the question read, Jahazi Limited is considering investing in the purchase of machine for its manufacturing process at a cost of 5 million. Installation cost of the machine is expected to be 500,000. The machine is expected to have a useful life of 5 years, at the end of which salvage value is estimated at 800,000. The investment shall lead to increase in sales, full stop. In order to support increased sales, the firm requires an extra investment in working capital at the start of the machine useful life. Inventory balances will increase by 1.2, debtors balance will rise by 1.5, and creditors balance will increase by 1.7. The additional investment in working capital will be recovered at the end of the machine useful life. The quantity of product to be manufactured and sold in each year are estimated as follows. So I've been given the year and the quantity in units. Additional information: the unit selling price and unit variable cost are estimated at 45 and 15 each respectively. These are expected to remain constant each year. The firm estimated fixed operating costs excluding depreciation is 100,000 per annum. The machine will require an overhaul at the end of the second year. This overhaul cost will amount to 240 million. The overhaul cost will be amortized separately on a straight line basis over the remaining useful life of the asset. The firm provides for depreciation on reducing balance basis at the rate of 32% per annum. The cost of capital is 13% and the corporate tax rate is 30%. So we're told using NPV, advise on the suitability or otherwise of the project. Advise on the suitability or otherwise of the project, and we had summarized all these values as our assumptions. Getting the initial costs, we had the cost of machine, which we have been given as 5 million. Then we had the installation cost of 5. We got our depreciable cost, which was 5. Then the working capital, if I can so under the working capital we did a working for that, because working capital we were adding the debtors, increase in inventory will increase and the debtors will increase by 1.5. So we were adding 1.2 and 1.5, increase in inventory, increase in debtors, and we minus decrease in payables, because payables in this case payables were increasing by 1.7, and we said from the perspective of cash flow statement, increase in debtors is an outflow, increase in inventory is an outflow, but increase in receivable is an inflow, and that's why we are minusing the 1.2, so that we get how much shall we need or how much shall we require as our initial investment in working capital. And when you do that, we got 1 million as our working capital, and therefore the initial investment, the total amount that we need in year 0 was 6.5. Then this investment was having a salvage value of 800,000. We had a salvage value of 800,000. Then the selling price, this was just by the summary of the items that we have. Salvage value was selling price was 45, variable cost was 15, operating expense was 100,000, and then we had overhaul cost of 240. Remember, overhaul is major repair, and you are told the overhaul cost was to happen at the end of the second year. The major repair of this particular asset, it was to happen at the end of the second year. Then our depreciation rate was 32%, and one thing you will note in this case, we shall depreciate overhaul separately. Overhaul was being amortized, so this was even an amortization, And the depreciation in note 4, the firm provides for depreciation on reducing balance basis, the 32%. Then 32% was the depreciation. The cost of capital in this case is 13%, and our tax rate is 30%. So here we shall come back to the depreciation on overhaul. We shall come back to that. So our years in the project, we're told we have 5 years. Yeah, we're told we had 5 years. This particular project had 5 years, and that's why we have year 1 to year 5. Yeah, we are told at the beginning that the useful life here, the machine is expected to have a useful life of 5 years. That's why we are having 5 years. And so already we had started these. These are just but the variables that we have to start with. The units we have been given, year 1 to year 5, the units, and already we know the selling price. Yeah, so to get the total sales, we said we shall take, getting the total sales, yeah, we activate equal sign. I will take my units multiplied by the selling price, and remember now the selling price is a constant. Selling price in this case is a constant, and therefore I will lock that because it's a constant. Just fully lock that, and I'll just drag this one, and you'll find that you'll get your total sales. Yeah, selling price is constant. We just lock to get the total sales for each year, Then after that, the variable cost that we had, again variable cost, remember it varies with sales, and I will take our units multiplied by the variable cost, which we shall fully lock because that one is a constant. It is not changing. It's a constant. Yeah, that's our variable cost. And you can go ahead to get the contribution. If you wish to get the row for the contribution, you can still minus the sales minus variable cost to get the contribution, but we just go directly and again put our operating expense. And again remember, operating expense will be a constant. It's not changing all through. We just lock that because it will be a constant all through. Then we were to calculate depreciation now. Depreciation of our equipment based on reducing balance. So the only thing that will clarify, whereby in the last question we did it wrong, when we are dealing with the reducing balance, it means that the item will not depreciate fully whenever we are using the reducing balance basis, and therefore in case of reducing, whenever the question requires you to use the reducing balance, we don't minus the salvage, and I will illustrate how they got 800. We don't minus the salvage. Salvage we minus only when you are using the straight line. The straight line method, that's when we minus the salvage value and we divide by the number of years, or we multiply by the percentage whenever they talk about the straight line. But for the reducing, we don't minus the salvage. Yeah, hoping I have corrected that. Yeah, we don't minus the salvage. So just go directly and we take our depreciable cost of 55 without minusing the salvage, and we deduct year 1 we don't have something to deduct, so just take the depreciable cost by the rate of depreciation, by the depreciation rate, and we'll get our depreciation being 1760 for year 1. But for year 2, I will use now the bracket, take my depreciable cost minus accumulated for year 1, and I close the bracket, multiplied by the depreciation rate, Then for year 3, I will take the bracket, my depreciable cost minus accumulated for 2 years, for year 1 and for year 2, and you can take the sum and again you multiply by the depreciable or depreciation rate. You do the same for year 3. You take our depreciable cost minus depreciation year 1, depreciation year 2 and depreciation year 3, and you multiply by the rate of depreciation, which is 32. And for the last year, I'll take my depreciable cost minus all these accumulated, because remember reducing, we use the net book value, and you multiply by the rate of depreciation, So those will be our depreciation depreciation for 5 years. So only to illustrate. Yes,
repeat.
Okay, so let me just repeat that. So remember, year 1 is direct. You have calculated depreciation based on cost. Because year 1 we don't have accumulated depreciation, we just take the depreciable cost, you multiply by the depreciation rate. But from year 2 onwards, we shall be basing our depreciation on net book value. When you talk about net book value, we shall be taking our depreciation cost or depreciable cost, we minus the depreciation cost for year 1, and you multiply by the rate. So the cost minus accumulated, then by the rate, you get depreciation for year 2. Then when you come to year 3, it has depreciated for 2 years already. So you take the depreciable cost, we find the net book value in short for the 2 years, the net book value for 2 years. So you're minusing depreciation year 1, depreciation year 2, and you multiply by our rate of depreciation, to get for year 3. The same when it comes to year 4, take the depreciable cost minus depreciation year 1, depreciation year 2, and depreciation year 3, and you multiply by our rate, and year 5 the same. So you take the depreciable minus depreciation year 1, depreciation year 2, depreciation year 3, and depreciation year 4, that way. And so sorry, this one I'm not multiplied, I multiply by 32% the depreciable rate, that way. And that's how you will arrive at the depreciation for each of the years there, whereby when you do the total for this one, the total for this depreciation for 5 years, you'll find that it has depreciated by 4.7, 4.7337. If you are to find the value, the balance, which is the salvage, what is remaining, so the total accumulated is 4.7. This is just but an illustration. The total was 5.5, the depreciable, minus the 4.7, the accumulated. You are getting 799,663, which is an approximate of 800,000. That's why the salvage, they arrived at the value of 800,000, because the machine will not depreciate fully when you are using the reducing balance, as opposed to straight line method, and that's why we have said whenever we shall be using, whenever you are first using the reducing balance, we don't minus the salvage value, because salvage value is the amount that will remain after you have depreciated the machine over the period or over the years that you have been given. So this one was just but illustration to prove the point for not deducting the salvage value. Then the other point is for the depreciation on overhaul or amortization. They're calling it amortization or depreciation on overhaul, and you'll find that for the overhaul, The overhaul value was 240, and overhaul we said is major repair, and we are told in number 3 the machine will require an overhaul at the end of the second year. This overhaul cost will amount to 240, and the overhaul cost will be amortized separately on straight line basis over the remaining useful life of the asset. So if it's at the end of the second year, that means amortization of the overhaul will start at the beginning of the third year. Yeah, the beginning of the third year. So third, fourth, and fifth. So we shall amortize it over a period of 3 years, the remaining life, and that's why it's a straight line. Yeah, they're talking about straight line over the remaining life. So you take the overhaul, divide by 3 years, and that's how we arrived at 80,000 as our depreciation on overhaul. But this one is from year 3, so 240,000 divide by 3 years to get an overhaul depreciation or amortization for 80,000 each year. So just lock that, and I'll drag that for that particular period. So it's a constant of 80, and now we shall be able now to get our earnings before tax. Earnings before tax. And remember our earnings before tax, we shall just take sales minus all these expenses that we have. And that's why I did not include negative. I've seen majority of you don't like working with negative, you just like minusing. So you take the total sales and you minus or you subtract this particular expense, and even I will minus this sale, so that will just drag. So year 1 our earnings before tax will be a negative of 1260. Yeah, I will drag that and autofill the other cells, whereby year 1, 2, 3 you find that we have a negative. Then our tax. So the other issue I need to address is the issue on tax. Yeah, ideally whenever you are dealing with taxation, you normally say we don't tax losses. Losses are carried forward ideally, but when you're dealing with capital budgeting, so this loss will find is as a result of the depreciation, and the depreciation is non-cash item. So there are two methods to deal with the depreciation whenever you are dealing with capital budgeting or whenever you are dealing with NPV. You either deduct depreciation and add it back because it's non-cash, and the reason you normally deduct it is for the tax purposes, or the other option is normally to add back the depreciation tax shield. When you're dealing with the tax shield, it means you will not deduct the depreciation, and if you are not deducting the depreciation, like in this case for year 1, the reason we are getting a negative 1260 is because of depreciation, which was 1760. If we did not have depreciation, ideally we could have 900 minus the 400. We'll have a positive value, and we'll tax that positive value and add the savings as a result of depreciation, and therefore the one that we call depreciation tax shield. And therefore, even if you are having negatives for capital budgeting and it is resulting as a result of depreciation, we shall tax the value, which will later be offset by the depreciation that we shall add it back. Because we shall later add depreciation back, it will offset that particular effect. Yeah, the effect of the negative sign that we are having on the tax, the effect on the negative sign that we are having on tax. So in this case, our tax rate is constant. We shall be able to lock, or we shall need to lock the tax so that we drag across, that. So we lock the tax and drag so that we get our tax, and we shall get our earnings after tax. So earnings after tax, we shall minus, so this one will be this value, and we minus the tax. Remember, the one that is negative, it will be added, but the ones that are positive, because taxes here we have not put the negative, they will be deducted. So our earnings after tax, we shall be having those values as our earnings after tax. Then we add the depreciation now. add depreciation. We add back depreciation. We add back depreciation. And that's why you'll find that the method of using depreciation and tax shield, for tax shield is normally a shorter, but again can be tricky if you don't understand it, because this one we have to less, then we come and add it back. We are supposed to add it back, but for tax shield you just add the depreciation tax shield and you get your values. So this is operating cash flow. Yeah, net operating cash flow that you are getting here. Net operating cash flow. So this one will be the sum of earnings after tax. We add depreciation, both depreciation on the main asset and the overhaul. So we add both of them to get our net operating cash flow. Yeah, so those will be our net operating cash flow for this particular project. And remember now the negatives that we had already, they have been taken care of when we have added the depreciation. And now our investment statement, already we had it because our initial was 6.5, but we have salvage. So here I can include my initial. Let me bring it here. My initial investment in year 0. Year 0 we shall need 6.5. That one we shall minus later because that one is in year 0. And remember we had overhaul. An overhaul cost was happening in year 2. Yeah, it was happening at the end of year 2. So in year 2 we shall have to minus that. We shall have to minus the overhaul because it will be discounted in year 2. It is an initial cost but under year 2, which is supposed to be minused or deducted after getting our operating cash flow, because that is an investment that we shall incur in year 2. Then we have the salvage. Salvage, remember we recover it at the end of the useful life. That is where we recover our salvage value. The end of the useful life, we recover our salvage value. So initial in year 1, year 2 we shall have let me just separate that. Let me just separate that. Okay, can just separate that so that salvage, for it to be separate, salvage of 800 and overhaul, overhaul cost. Let me just call it overhaul cost separately, minus 240, so that when you are going through it you can be able to understand we had an initial and we had an overhaul cost of 240, and you get our cash flow now. Investment cash flow. Investment cash flows.
Hello, Mwalimu.
Yes.
We were to recover the additional working capital at the end of the project.
We were to recover additional working capital. Just a minute. Thank you, Jared. Had forgotten that. So we had working capital. Yeah, we were to recover that at the end. The additional investment in working capital will be recovered at the end of the machine useful life. Yeah. So working capital. So you can either call them terminal and you add the two, the salvage and the working capital under the salvage. Working capital, terminal values. You either call them terminal values and you add the two, or you can just separate them as working capital and the salvage value, and we are recovering it at the end of our useful life, that way, and you'll get your cash flow now. Investment cash flow. Investment cash flows. Investment cash flows. So remember in year 1 we only have the outflow in year 0, and then year 1 can get the sum. I think it will be easier. from operating, yeah, that way, so that I can drag this, yeah, that way. So those will be our cash flow for this particular project. Yeah, our cash flows, the initial for year 0, year 1 up to year 5, then we find out the NPV, because the question requires that to find the NPV. So our NPV of the project, NPV, so this will be equals to NPV. Remember, NPV, we require the rate. Already we have the cost of capital, and we require the values from year 1 up to year 5. I close the bracket and I minus the initial, my initial cost, which was 6.5, that way. And altogether the project has an NPV of negative, that is a negative 3,107,830. To determine using NPV, advise on the suitability or otherwise of the project. And you know the acceptance rule for NPV, it must be greater than 0 or it must be positive, in other words. So our advice, the project is not worthwhile, or the project is not, so advise on the suitability, yeah, the project is not suitable. Our advice, the project is not suitable, the project is not suitable, it's not suitable as it has a negative NPV, so it is not suitable because of the NPV that is negative. So that's how that question on NPV was supposed to be tackled. Yeah, the issues of depreciation, the issues of overhaul, and again the overhaul, deducting it in year 2, working capital, and the salvage, with 2 questions labeled sensitivity 1 and sensitivity 2, sensitivity 1 and sensitivity 2. So hoping you are there so that we can go through that. Okay, so we shall look at this first one, sensitivity 1. Still is incorporating the capital budgeting and sensitivity analysis. Generally, sensitivity analysis, whenever we are dealing with sensitivity analysis, goes hand in hand with scenario analysis, because under sensitivity analysis, it is a study whereby we normally ask ourselves, what if the worst will happen? What if the variable change by a certain percentage? What will happen to the NPV? What will happen to the viability of the project? And one of the assumptions that sensitivity analysis entails is we assume that each particular variable will be varied in isolation, or it will change in isolation while keeping the other variables constant. So the others will not vary, but only one variable we shall be able to change it at a time while we keep the other variables constant. And when we are keeping the other variables constant, it means now we shall be seeing the sensitivity of that particular variable to the project NPV. That if we change one particular variable, how much will the NPV change as a result of that change in one particular variable? Will it increase or will it decrease? And you'll find that we normally look at it in 2 ways, but most of the time we look at an adverse variation. Adverse is negative. For incomes, adverse variation for incomes means the incomes will reduce. For cost, it means the cost will increase. Under variance, it will increase, and therefore that's why we do consider each and every variable in isolation and see how the project will be able to respond when we vary that particular one variable. So in short, when we talk about sensitivity analysis, it is varying project variables one at a time and noting the change in the project NPV. And for you now to note the change in the project NPV, it means that you must have to get the original NPV, which we call the base case NPV, so that you can be able now to study the changes of the other NPV as you change the other variables. So we look at this question as an illustration. Viwanda Limited is considering purchasing a machine at a cost of 40 million. The company will incur an additional 20 million to modify the machine for special use. The machine is expected to have useful life of 3 years and a scrap value of 15 million after 3 years. The investment will require an investment in net working capital of 2 million at the beginning of the useful life. The additional investment in working capital will return to normal at the end of the machine useful life. The machine's purchase will not affect revenue, but it is expected to save the company 25 million each year in before tax operating cost, mainly labor. The corporate tax rate is 30% and the company cost of capital is 10%. So you are required advise Viwanda Limited on whether to buy the machine. And number 2, suppose the firm's management is unsure about savings in before tax operating cost. Carry out a sensitivity analysis on this variable, assuming that the variable shall vary adversely by 10%. So you need to carry out the sensitivity, and remember now sensitivity, it will be the impact of change of that variable to the project NPV. How will the NPV respond when we vary that particular variable? So this question, to answer number A, we advise whether they should buy the machine. Remember, our advice again will be based on NPV. If the project NPV will be positive, then we should go ahead and buy the machine. But if the project NPV will be negative, then we should not buy the machine. Yeah, so that is under Roman 1. Under Roman 1, whether to buy the machine. We advise them on whether to buy the machine. And you'll find, if we can summarize what we have, we are purchasing the machine at 40 million as our purchase cost. Our purchase cost of the machine, and these are in millions. We're purchasing it at 40 million. Just work with million of shillings, and we are told we shall need to do modification. The company will incur an additional 20 million to modify the machine for special use. So we shall have modification cost of 20 million, giving us a value of 60. This one is what we are calling the depreciable, because this will depreciate. Both the purchase and modification will depreciate. Depreciable cost. And apart from that, we need additional. The machine under the paragraph line 3 or line 4, the investment will require an increase in net working capital of 2 million at the beginning of its useful life. So working capital shall need working capital of 2 million, meaning that our initial cost that we need for this particular project, our initial cost or initial outlay will be 62 million. Will be 62 million as our initial outlay. Yeah, so it will be logging us out in a minute's time, so that we log in and complete the question. Yeah, so 62 will be our initial outlay, and then we can get now our NPV, because the others we know is the scrap. We have a scrap value, buy the machine. We should go ahead and buy the machine. So that is the first part. The first part of that, we should go ahead and buy the machine because the NPV is positive. So the second part is for the sensitivity analysis. So this one is what we call the base, whereby we have assumed everything will remain as planned. Everything will remain as planned, and that's what we are getting as the base. So for the second part is whereby now we are told, suppose the firm's management is unsure about the savings in before tax operating cost. Carry out a sensitivity analysis on this variable, assuming that the variable shall vary adversely by 10%. So the only thing that now is changing is our savings before tax operating cost. So remember, here we had savings of 25. Now what if it varies adversely by 10%? What will happen to our project? What will happen to our project? So this is the second part, sensitivity analysis. Sensitivity analysis. If savings on cost varies adversely by 10%. If it varies adversely by 10%, what will happen to our project? What will happen to our project? And you'll find in this case, I can just copy this. And I'll paste it. Let me paste it here, and I'll paste with formulas. I've pasted it with formulas. So this was our savings on costs, and the other values are after depreciation, operating cash flow, initial, scrap, and working capital. The others I will fix them. Values that I don't have, I'll fix them and see whether the formulas will work. So here 0, okay, so the others I will fix them. So as long as I have this shell, I can fix the other values. Remember, in this case now, what is changing is our savings. Which will now change. The values that we had initially will change. We had 25, but will change. This value now will change by adverse. We have said adversely it will reduce. It will reduce by 10%, meaning that whatever we shall remain with is 90%. We shall only be able to recover 90%. It will reduce by 10%, meaning we shall recover 90% of that value. And in this case, okay, just a minute to make it easier, you'll find that here it is reducing by 90% by 90%, so that here I will multiply by 90%, which I will fully lock because it's a constant, even that one, so that I will drag these across. So savings, it has reduced by 10%, meaning we are able to recover only 90%, and when we recover 90%, the tax will reduce. You can see automatically it has deducted tax to 6.75 because already we have copied with the formulas, our earnings after tax becomes 15. Our tax shield, remember it was a constant, that one is not changing. Remember under sensitivity we have said is only one factor that is varied, and here tax is changing because it is connected with the savings. If savings changes, tax will change, but depreciation tax shield will not change because that one is not connected with savings. So our operating cash flow now will change to 20.25. remember initially we had 22, but now it changes. So initial will remain the 62 that we had initially. Yeah, I had not copied the NPV. Okay, so the final values and our working scrap value will remain the value that we had 15, and working capital will remain the 2 that we had. So working capital is remaining. The only values that we have changed is the savings. Yeah, the savings is the one that we have adversely affected by the percentage of 10%. We have been able to recover the 90% of that, and that's why now our values, we shall have those as our new values, and therefore we just calculate our NPV. We calculate our NPV based on the new values that we have. I did not copy even the NPV, but it could have changed even the NPV. So here our NPV, so NPV is equals to NPV. So the rate remains cost of capital of 10%, that one remains, and our cash flows, the 3 of them will remain, and we minus our initial, which is 62. I convert this into number, and you will find that our NPV is 1.13. If we vary our savings by 10%, our NPV will become now 1.13. Yes, still the project will be favorable, or it will still be done because it has a positive NPV, but when you look at the percentage change or change in NPV, you will get that we shall have this, and we minus the initial amount that we had, divide by the initial amount. Just need to get like the percentage change in NPV, the current NPV minus the initial NPV, divide by the NPV. We'll get that our NPV will change by 79%. That's how sensitive savings are in this case. That a small change in NPV, we have a small change in savings, we have reduced savings by 10%, but we'll find that the change in NPV, it will change by 79%. So it will give a very big margin change in the net present value, and that's why when you talk about sensitivity, we are looking at the sensitivity of that particular one variable, to changes in NPV. That if we change one variable, how will it affect the other variables, or how will the NPV change in that manner? So that's how the questions, whenever you are dealing with questions of sensitivity analysis, how you deal with it. We value, or we just vary one item at a time. and you get the effect, or you get the NPV, you get the resultant NPV. And now if there were several like the other question, I'll just open it briefly, even if maybe we may not go through it all. Yeah, the question that was you were supposed to do.
Have you shared?
Let me share. I was tracing that particular, it was the revision questions. Yeah, the folder or the workbook that was having the revision questions. Yeah, I'm sharing my screen. I'm sharing my screen. I'm hoping now you can see my screen. Yeah, the question on sensitivity, it was under the workbook of revision questions. It was just one of the question under sensitivity and the sensitivity analysis and the sensitivity analysis. And you'll find that the question was reading, I'll read this. R Limited is considering a project with the following cash flow. So we had year 0, 1, 2, we had the cost of plant, running costs, and we had savings. R Limited cost of capital was 9%, and you are required, number 1, determine the sensitivity of the project to changes in the level of cost of plant, then running cost and savings, considering each factor at a time, assuming each factor is varied adversely by 10%. So the same criteria or the same thing that you have done. So in this case, each factor is varied adversely by 10, and you are to comment on the factor. You are to comment on the factor which is most sensitive to adverse variation. So you are to comment on the factor which is more sensitive to adverse variation. So you are supposed to do this. Yeah, to do this one, and trying to eliminate this. Just a minute. And ruler grid lines are already there. Okay. Yeah, so I'll just do it here. I'll need to do it here. So here in you have to do, you are first to find the base case. Yeah, the base case. Base case NPV is a normal NPV. Base case NPV is a normal NPV. There were 3 years. There were 3 years. So year 1, year 2, and year 3. Oh, there were just 2 years, not 3 years. Yeah, there were 2 years. Year 1 and year 2, and year 0. So remember, year 0 we are having the cost of plant, we have running cost, and we have savings. We have savings. So in this case, we are to start with savings, and savings, they were constant in both years. You are having savings of 12 million, and you are having running costs. Yeah, running cost of 4 in year 1 and running cost of 5 in year 2. Therefore, the cash flow for this one, the cash flow, you just minus the 2. You have to take the savings minus the running cost. Savings, and you minus the running cost, you get the cash flow for the 2 years. You get the cash flow for the 2 years. Remember, the question did not have the tax. Yeah, we did not have the tax, so you are not taxing. Just take the cash flows the way they are, because there was no tax. The only thing that you have been given is the cost of capital, which was 9%, and we have our initial cost. That is the cost of plant. The cost of plant. Remember, cost of plant, this one now is in year 0. In year 0, which was 10 million, the cost of plant. So your cash flow, or project cash flow, in this case, project cash flows, they are just the same values here. Year 0, year 1, and year 2. It will be the same values there that you are now supposed to discount to get the NPV. To get the NPV, so your NPV, already we know the NPV, we know the rate. Our cost of capital, or WCC, is 9%. and the values that we have, there are only two, the cash flow, and we minus the initial of 10. We minus the initial of 10, the initial of 10, meaning that the base case that we have is 32 as our base case, 32 as our base case NPV. Base case NPV is 32. So what if now our sensitivity analysis, the base is just by the normal NPV, the normal NPV. So what if now determine the sensitivity of the project to changes in the level of cost of plant, running cost, and savings. So sensitivity analysis, and here we start with the change in cost of plant. What if now the cost of plant changes adversely by 10%? What will happen to our NPV? And in this case, you just copy the initial that we have, and we paste it here with formula. Yeah, so yeah, paste it with formulas. Just wonder why it has not captured that. Just a minute. Okay, just hoping that the formulas already are intact. Okay, so because these other values will remain, the only thing that will change, these values will remain, the only thing that will change is the running costs, not the running cost, but the initial costs, because it's the value that here we are varying, the value that we are varying here. Yeah, so those ones will remain, and so the cost of plant here now is the one that will change. Remember, initially we had 10. Now we are varying it adversely by 10, meaning that we shall multiply the initial cost of a plant by 90, not by 90 adversely, because it's a cost, it will increase by 110. It is a cost, it's not a saving like the previous question that we were dealing with savings. So this is a cost. So adverse for the cost will increase. Adverse for savings, the savings will reduce. So we shall multiply it by 110, and therefore our NPV should be, because this one will be 11 million now, this one remains 8, this one remains 7. So I'll calculate my NPV. I will recalculate my NPV. So my rate remains 9. My cash flow is 8 and 7, and I minus my initial now, which is 11. My initial, which is 11. I convert this value back to numbers, and I'll show this. Yeah, that way. You'll find that now if we change the cost of plant adversely by 10, our NPV becomes 2231. Our NPV becomes 2231. Can use a different color just to show that. The next, you're supposed to vary now the running cost. We vary the running cost. Can still copy the initial amount. I'll paste it twice. So we look when we vary the running cost. So here is for running cost. If you vary running costs adversely, just copy this and paste it here with the formula. and the other one I'll paste it. Let me paste it here. The other one, yeah. So this one will be for savings. This one will be for savings. So here we are varying the running costs. So this one, remember, we just fix the values. So that is savings, running costs, cash flow already we have. This was the initial costs, the cost of plant. Yeah, that way. So remember, for the savings are constant here. The only thing that will change is the other value, the other values. Yeah, here because we did not do lockings, that's why the values are changing, or we are not be able to copy the values directly. So here now we shall change the running cost. Again, it's a cost, it is a cost which we shall change adversely by 10%, meaning year 1 we shall take that by 110. It will increase by 110%, and even for year 2 it will increase by 110%, and you'll see that our cash flow will reduce. The initial remains constant at 10. The initial will not change, it will remain constant, and that's why we are saying we are varying one variable at a time. Here the variable that we are varying was the cost of plant, the others were constant. Here we are varying the running cost, the others are constant. The others are constant, and therefore the NPV here, the NPV under this scenario will be NPV. Our rate remains 9. Rate remains 9. Our cash flow, and we minus the initial. The initial is 10, and you get your NPV. You get your NPV as that value. That value. So here again it changes now to 24. Changes to 24. Here we had 22. Here is 24. And the other one now for savings, yeah, for those one that were not able to complete, you will complete the same procedure. The only thing now under savings, you will only vary the savings. The other values will not change. And remember now the savings are varying adversely. Yeah, savings are varying adversely, meaning that savings for year 1 we had 12, and you will now multiply by 90, because savings will reduce. Savings will reduce. Savings will reduce. The same, because they are constant, they are the same. You will vary it again by 90%. You will get that value, and the cost will remain. The key thing is to know that we are varying an item at a time. The cost will remain. The cost will remain constant. Yeah, and you'll see that. And the cost of plant will also remain constant. Cost of plant will also remain constant, meaning your NPV will be the rate which we had there, and the values which have already reduced, and you minus your initial, which is a constant of 10. It did not change. This one we convert it to a number. Yeah, that way. And you find that in this case, when you vary savings adversely, it is giving us an NPV of 1,120,000. The other one is 2. They are 2.4, 2.2, and the initial one was 3. If you can calculate the percentages the way we have calculated, you will note that the one that has the one that is most, according to number 2, the factor that is most sensitive to adverse variation will be our saving, because it's the one that gives a very big margin reduction in the value of NPV, the value of NPV. So that's how that question was supposed to be calculated for sensitivity analysis. So you'll attempt that question that we have left, sensitivity 2, under the one that we have started with sensitivity 1 as your assignment.